Global markets are down 20 to 22% since the start of the year. We often say that the stock market is a leading indicator of the economy, meaning that when it's up, the outlook is generally positive, but when it's down, it means that there's bad news ahead. So by looking at this chart, really, we have to ask ourselves, why are investors freaking out? And the reason is two things, really. One is inflation, and the other is slower growth. So in other words, the fear of something called stagflation, which is an environment in which the economy isn't growing, so it's stagnating, but prices are still going up very fast, with the result that we are all poorer. Just to be precise, when I say inflation, I mean inflation being higher than forecast and for longer than expected. The CPI, the Consumer Price Index, is up 9% in both the UK and the US, and although central banks have been raising rates for the past 6 months, the effects of this tightening are slow to come through the real economy. So I'm afraid that for as long as we will see this trend to continue, we have to get used to equity markets posting negative returns. At the end of the day, inflation feeds off human misery. Its favorite diet is war, disease, and disruption. We're so lucky we have all of them at the moment. I suppose the big question is now, will central banks be able to control inflation? Because it's impossible to predict the future, I'm not going to spend any time on that because our best bet is to look at the past and see what happened then. Last time we had inflation on 9%, it was in the 70s, and that's why in the early 80s the Federal Reserve put in place restrictive monetary policies in order to suppress inflation. What happened then? Well, as you can imagine, these policies caused a recession, because when you suppress economic activity, output and aggregate demand go down. But fortunately at that time, businesses and households were in a strong financial position, so they were able to deal with it, and it was a relatively mild recession. What happened next is that we had 40 years of deflationary environment, with prices slowly but surely going down over time. And it's important to point out that this deflation didn't only happen because of the activity of central banks, because there were other forces going on at the same time. First of all, the opening of China to international trade, which was offering cheap labor and cheap products, but also technological improvement and increased participation of women to the workforce. All of these forces contributed to increase the supply of labor compared to the demand, which had the effect of pushing wages down, and usually when this happens, prices in the economy follow. Was this good news overall? Well, in hindsight, yes, because low inflation prompted central banks to keep interest rates very low in order to stimulate demand. And although monetary policy didn't succeed in starting inflation, because for that we had to wait for COVID, global supply chain disruption, and the war in Ukraine, it did provide enormous support to risky assets, because now they were the only place to be given that the risk-free rate was so low. That's why we had the secular bull market in equities, with stocks posting abnormal returns for most years in the past 4 decades. Today, instead, we are at an inflection point. A recession seems inevitable, and we're starting to see the first signs in developed economies. But the main problem is that those deflationary forces that worked in the 80s and afterwards are not here anymore, and to some extent they're being reversed. Deglobalization, for example, is a trend, which means that manufacturing will be done closer to our homes, but it will be more expensive. Changing demographics, because an aging population does not produce but still consumes, and this put pressure on prices and the workforce as well. The changing role of China, obviously not the workshop of the world anymore. And last but not least, commodities, which are now more expensive. And this is not just because of the recent war in Ukraine, but also because of ESG, which has made exploring and drilling and fracking way more difficult and expensive. So the bottom line is that if we're lucky, recession will not be too severe now, but inflation will persist for longer, and we'll have to get used to higher interest rates and also negative returns for equities. Once the rate hiking cycle concludes, though, we should have a period of normalization. By then, in fact, we will have some level of inflation, which will be lower than the levels we see today, but still moderately high, and high interest rates but falling, which is important because it's really in this second phase the risky assets get rewarded. Will this start a new multi-year bull market spanning decades? Well, that's always the hope. And logic and experience tells us that there's an opportunity for that to happen. So I'm going to leave you with that positive thought, thanking you always so much for watching this far, and I will catch you very soon.